Hello and welcome to the Daily Brief Show by Zerodha. On this show, we cut through the noise and simplify the biggest stories and trends that are shaping the markets. I'm your host Anurag Bansal. Today is Thursday, the 29th of August, and I have three big stories for you. You can find us on Spotify, Apple Podcasts, or wherever you consume your podcasts. And if you like reading instead of watching or listening, you can also consider subscribing to our No Spam newsletter for a quick rundown every morning. You can find all the links in the description. So let's start with the stories. I first talk about India's new signature alcohol. Then I move on to discuss what is happening with crude oil. And in the third and final story, I talk about the potential NSE IPO. So let's begin. See, India might soon get a signature drink. According to one estimate, the global alcohol beverage industry is worth about 1.7 trillion US dollars. Despite the harmful effects, alcohol is very much a part of the culture of most countries. They don't call it a social lubricant for nothing. Signature alcohol beverages are often a part of a nation's identity, and they have also their own special ingredients that makes their own drinks very special. For example, Scotland and Ireland are very popular for using barley in their whiskey. On the other hand, Canada and America are very popular for using corn, rye, and wheat in many of their whiskeys and bourbons. But unlike these countries, India today does not have a recognized primary ingredient or a signature spirit. A diverse range of alcohol beverages are produced in different states within our country, such as Feni in Goa, Mahua in central India, and Arak in South India. But India as a nation as a whole still has not developed a distinctive spirit that can be marketed globally. The Indian alcohol market is currently dominated by locally produced versions of European spirits like whiskey, rum, gin, and vodka. Indian manufacturers have created and adapted versions of these foreign spirits using local ingredients, but no drink really stands out as truly Indian. Diageo and Pernod Ricard, two of the biggest distilleries operating in India, are now looking to incorporate grains like millets into their whiskey in order to create a signature Indian style and flavor. But why millets, you might be wondering? Look, that is because millets are very resilient crops. They are very tolerant of heat up to 64 degrees Celsius, droughts, and even floods. This makes the crop special in an era of climate change. These properties make millets perfectly suited for India's climatic conditions, which is a mix of dry and semi-dry regions. From a consumption standpoint, millets are very rich in nutrients like fibers, vitamins, and even minerals. Another interesting property is that millets are also gluten-free. And this is important because more than 8% of the world's population today is gluten intolerant. So, considering the crop's overall potential and India's agricultural climate conditions, the Indian government has been very actively promoting millets for the past few years. The push has been so significant that United Nations declared 2023 as the International Year of Millets in order to help promote them globally. Currently, India produces about 40% of the world's millet, and we are a worldwide leader in its production. No other country today comes even close to us. So if India truly wants to create a signature style of spirits, millet seems to be the best suited ingredient for us. Traditionally speaking though, millet-based alcohol drinks are nothing new and they have been around for a while now. This is more prevalent in rural India and tribal communities. To give you some examples, ragi, which is a form of millet, is commonly used to make drinks like ragi beer or ragi wine in southern parts of India. Similarly, bajra, which is another kind of millet, is used in Rajasthan very commonly to make traditional alcohol drinks like bajra chang. Some breweries across the countries have also started to pick on this trend and have started serving millet-based beers. But talking about this opportunity, the CMO of Diageo India said, and I quote, "India, on the path to become a more affluent nation, is looking more to its own roots to discover what is good versus something that is just aping something that's happening globally. So there are innovations with ingredients such as millets, rice, or any other grain." She also spoke about similar movements in the Western alcohol beverage markets and said, and I quote, "The US had its moment with the bourbon and Canada with rye. It is about really looking at that unique blend of what is Indian, and we do a lot of innovations in our process because we have a very different temperature, different maturation, different climate zones across the country." Another really big distillery operating in India, Pernod Ricard, which owns brands like Absolute Vodka, Chivas, Jameson, etc., is also taking a very similar approach, but they are doing this with an added focus on sustainability. Their focus is on creating an authentic Indian spirit while reducing water usage, lowering methane emissions, and creating new opportunities for local farmers. Now, this can surely be a big change in the country, and if this does happen, the potential rewards for India's alcobev industry, especially in terms of exports, could be really immense. For your context, in 2023, India exported alcohol beverages worth only 300 million US dollars, and this number has been relatively very flat over the last many years. India is not even in the top 20 list when it comes to alcohol exports globally today. Overall, though, it'll be very interesting to track the alcobev space and all related listed entities over the next couple of years. If we do manage to utilize the government's push towards millets, it could really boost India's global perception in an industry that is deeply ingrained in worldwide social culture. Moving on to the second story of the day, let's talk about crude oil. Look, the energy markets have been one of the most entertaining segments in the broader financial markets in the last 5 years or so. First, crude oil prices went negative after COVID. Then, after reopening, we had a massive rebound in crude. Then, in 2022, Russia, which was the world's second largest producer of crude at that point in time, invaded Ukraine, which sent oil prices soaring above $120 a barrel. But since then, crude prices have come down, and for the past 1 year or so, we have been stuck in the range of 70 to 90 US dollars. As of the time of this recording, Brent crude was trading at 77 US dollars. This is despite the recent flare up of violence in the Middle East between Israel and Hezbollah. Now, the reason why I'm talking about crude oil in the first place is because crude is an important input into numerous things. If crude oil prices rise, everything from airlines to agriculture to textiles to construction, food, manufacturing, pharmaceuticals, etc., everything will be affected. The other reason is that there is a lot happening, and this is fascinating to say the least. At a high level, something that's interesting is that despite all the geopolitical shocks and concerns we've seen this year, crude prices have not spiked dramatically. They've been volatile, of course, but they've remained in a range, which is good news for all of us as consumers. Over here, it's a little important to talk about demand and supply of crude. Now, there are three major organizations that publish widely followed forecasts. First is the EIA, or the US Energy Information Administration. Second is IEA, or the International Energy Agency. And the third is OPEC, or the Organization of the Petroleum Exporting Countries. Now, all of these three agencies released their recent forecasts, and there is something weird happening there. OPEC expects demands in 2024 to grow by 2.1 million barrels per day. The EIA expects demand to grow by 1.1 million barrels per day, while on the other hand, the IEA expects demand to grow by just under 1 million barrels per day. And just for your context, the world consumes over 100 million barrels per day. But when talking about forecasts, I'm essentially talking about an incremental oil demand per day from the 100 plus million barrel per day mark. Historically speaking, though, there haven't been such huge differences between the forecasts of these agencies usually. These gaps reflect the biases of these institutions. For example, OPEC demand forecasts typically tended to be conservative because the members of OPEC are oil exporters and they would worry about oversupply. The demand focus of IEA, on the other hand, tended to be more aggressive, but in the last couple of years, this gap has widened significantly. Now, apart from the institutional biases, I think there is something interesting happening. The first factor for weak oil demand is China. It is always China, isn't it? As we've already spoken before in great detail, China is facing massive headwinds in its property sector, which accounts for over 30% of the country's GDP. Home prices in China have been falling continuously since 2019. Along with it, sales have taken a hit and number of new projects have also hit record lows. All of this means low oil demand, and this has put a cap on global oil demand. But it's not all bad news here. There are a few other interesting things happening in China. First, even though passenger cars account for only a very small percentage of diesel and gasoline demand, the transformation here is truly staggering. Over 50% of all new cars being sold are electric vehicles in China. Second, if you thought the first point was stunning, that is nothing. Heavy-duty vehicles like trucks account for the bulk of diesel demand in China. Even there is a massive adoption of electric. The market share of electric heavy and light commercial vehicles has increased to 10 and 16% respectively. On top of this, there is also a rapid shift to LNG trucks. All of this is leading to significantly lower diesel demand. Third, but one of the biggest reasons that oil demand seems to be reducing is because of tariffs. As we've spoken previously again, China has been dumping everything from electric cars to steel to chemicals and even solar panels to over the world. This is worrying countries, and everyone from the US to Canada to Brazil and even Europe have been imposing tariffs on Chinese goods. Now, if tariffs go up, Chinese exports will fall, and that will lead to lower freight movements within the country, which will naturally reduce exports. Now, it is important to know that this is a slower trend, but it has definitely put a ceiling on Chinese oil demand. The second aspect of this is what OPEC is doing. Since 2022, OPEC and Russia had cut oil production by as much as 6 million barrels per day, or about 6% of the global oil demand. These cuts are set to expire over the course of 2024 and 2025, starting in October this year. Compliance with these cuts is always a question, but countries more or less comply, barring a few 100,000 barrels here and there. But the context in which these cuts have happened is very interesting. Typically, OPEC cut oil supply when crude prices fell sharply to say $50 or $60 per barrel. But when OPEC cut supply in 2022, crude was well above $90. Why, you must be wondering? Well, OPEC countries, especially Saudi Arabia, are spending more domestically and their budget requirements have gone up. This means they need higher prices to keep up domestic spending. In fact, one Bloomberg article said that adjusted for Saudi's fiscal spending, the break-even point of Saudi oil is between $100 and $105. But OPEC cannot keep up these cuts forever. There are already signs for trouble. Countries like the UAE have been asking to pump more oil. The longer OPEC keeps these cuts, the weaker the compliance will be, and countries will just ignore and start pumping oil, which will force oil prices to crash. The other factor is the rising oil production from non-OPEC countries like the United States, Canada, Brazil, and Guyana. At $70 to $80 a barrel currently, prices are attractive enough for US shale producers and these countries to invest more and produce oil, which means when OPEC is trying to put a floor under oil prices at $70 to $80, other countries are increasing their output. Moving on to the final story of the day, let's talk about the potential NSE IPO. See, on Tuesday, NSE, which is India's largest stock exchange, restarted its efforts to go public. This is a journey that NSE has been on for over 8 years now, but it keeps getting stuck due to regulatory issues. For your context, here is what happened. Back in 2015, a whistleblower blew the lid off a major problem. They claimed that NSE was giving some traders an unfair advantage, letting them place their trades faster than everyone else. SEBI, which is the market regulator, jumped on this immediately. So what was the deal, you might be wondering? Look, NSE had multiple servers to handle trades, but not all servers were created equally. Some were faster than the others. While this difference in speed might not matter for some regular traders, it was a very big deal for algorithmic traders, those who use super fast computers to make very rapid trades. A few microseconds here and there in this case could mean the difference between winning or losing very big amounts of money. Some smart traders figured out that by using these co-located servers, which by the way is just a fancy term for servers located inside NSE, they could trade way faster than the others. But some traders took it even further. They allegedly got NSE officials to hook them up to the best and fastest server every single time. This unfair advantage skyrocketed their profits. When SEBI eventually discovered this, they were obviously not happy, especially since a big chunk of NSE's revenue, over a third of it, came from these co-located servers. SEBI could not let NSE go public with all of this mess because if the money was tainted by unfair practices, how could they justify selling shares of the exchange to the public? So in 2019, SEBI cracked down. NSE was fined 625 crore rupees plus 10% interest and was banned from the capital markets for 6 months. SEBI also put a pause on NSE's IPO plans until things were cleared up. But fast forward to May this year, a group called the People Activism Forum stepped in and took the matter to the Delhi High Court. They argued that SEBI's 6-month ban could not keep NSE from going public forever. Interestingly, Indian law does not outright stop companies with pending cases from going public. So if NSE does finally get to IPO, it would be massive. We are talking about the 8th largest stock exchange in the entire world. No other exchanges trades more derivatives contracts than the NSE today. Companies worth a total of $5 trillion are traded on it. NSE is also massively profitable. In the last quarter, it had revenues of 4,500 crores and a profit of 2,500 crores. However, there is another challenge on the horizon. SEBI is currently looking to rein in speculative trading volumes in NSE's options markets, which has seen explosive growth from FY 2020 to FY 2024. They're focusing on equity index derivatives, which make up a large part of NSE's trading volumes. According to a report by IIFL, if these measures are approved, NSE's trading volumes could drop by about one third, and its earnings might take a 20 to 25% hit by FY 2026. Now, the final decision is still pending, so the impact remains uncertain. Back in 2016, NSE was looking to raise 10,000 crores through its IPO. It remains to be seen what the number will be this time around. Now, in a small special segment today, I have three tidbit stories to talk to you about. First, if you remember, in the 27th August episode, I discussed how the global shipping crisis had an Indian twist in it. I also mentioned that time that dock workers were planning to strike on the 28th of August to protest the delay in concluding their wage negotiations. But now the union representing 20,000 workers from 12 major Indian ports has decided to withdraw this strike. This comes after an agreement on wages with the Indian Ports Association or IPA was reached. The dispute over wages had begun when the previous settlement had expired on 31st December 2021. Now, the Wage Committee and the IPA have reached an understanding. The union accepted an 8.5% wage increase over the next 5 years, which is effective retroactively from 31st December 2021. There is also a 30% variable dearness allowance, which is effective 1st January 2022. So I guess all's well that ends well. In the second tidbit story of the day, I wanted to talk about Zee and Sony's failed merger. See, Zee Entertainment Limited and Sony India's businesses were all set to be merged as per an announcement in September 2021. After 2 years of massive drama, the merger was all set to happen. It even received the blessings of bodies like NCLT, CCI, NSE, and BSE. But strangely, the cutoff to complete the merger expired on 21st December 2023, and the merger was called off in January this year. The tale does not end here. After the merger was called off, both parties ended up in a legal battle over who would pay the $90 million termination fees. Finally, this week though, after many months of back and forth, Zee and Sony announced that they would withdraw their claims against each other. Both parties have now agreed to a mutual non-cash settlement once and for all. In the third and the final tidbit story for the day, I want to talk about Zomato acquiring PayTM's ticketing business. Look, Zomato has acquired PayTM's events and movie ticketing subsidiaries for a massive 2,048 crore rupees. To give you a context of how large India's events market is, the market earned 8,800 crore rupees in 2023. India's movie market grew by 14% in 2023 and it was worth 19.7 thousand crore rupees. And Zomato wants a piece of this action. But why? You see, Zomato's going out business, which includes dining out and event ticketing, had already made 3,200 crores in FY24 and was growing at 136% year over year. So by acquiring Paytm's ticketing business, it looks like their idea is to double down on this segment. This would seriously threaten BookMyShow's singular dominance in the Indian ticketing business. Zomato is very optimistic about growing its going out business to a 10,000 crore rupees brand. That's all the news I have for you today. I hope you found value in this episode. I'll see you tomorrow. Take care and goodbye.